Could we touch lightly a bit on how the family home works, what most expats are generally doing, assuming the whole family goes offshore? And then I suppose it does get trickier if, say, hubby goes offshore, mum's staying home, and there's kids here, and then they work out residency and so on. But if we use a simple scenario, everyone goes offshore, the family home usually gets rented out point in time. But then in that scenario, there's no CGT discounts. What is it looking like in that stage? And does the 6-year rule, is that even still relevant for someone if they owned it for say 10 years and then went offshore for say 3 and come home, play around with the 6-year rule there at all?
Yes, yeah, really good question. So really important that the principal place of residence rules haven't changed since our last major change a few years ago. That last major change was principal place of residence exemption is still around, but you have to be a resident for tax purposes when that sale event happens. In a really simplistic situation, you bought a house, you moved into it, you've established it as your family home, then got an overseas posting for 3 years. Now, really simple, go ashore 3 years, have a good time, rent out the house during that time, then come back and return to the property and continue living there. So in that situation,
Welcome back to the Winners Playbook. Today we have a return guest, Tristan Perry, Managing Director of Tax and Accounting at RP Financial Private. Timely podcast to have Tristan here with us again today with everything going on in the budget and some of the largest change to the tax system we've seen in some years. The topic of investment and moving offshore has never been more relevant. Today we'll be building on what we discussed back in October last year when Tristan first appeared on the podcast. I hope you enjoy. Tristan, welcome back, mate.
thank you, mate. Thanks for having me.
It's good to see you. I haven't seen you from when I was last in Singapore, which was last year, and we did the podcast in October 2025. That was online.
We did, yeah, the online one, and I was joining you from sweaty Singapore, and now I'm in freezing cold Melbourne. So it's nice to be back.
Yeah. So what's sort of changed over the last? Well, it hasn't been a full year, but what's changed in your end? So you've come back and living back in Australia.
Yeah. So we had a kind of a change in situation, which kind of happens with a lot of expats. So 10 years in Singapore, probably would have been there forever, to be honest, if there was no kind of driving force to bring us back. Family. So her family was the main reasons with a lot of my clients. It's sort of either employment or family, which is the reason why they come back. And for us, it was family. So, it's sort of nice to be back close to the relatives and that sort of thing, and, kind of getting back into Aussie life.
Yeah, well, I've seen a few clients that I've got working offshore, particularly over in the UAE with all of what was going on in the Middle East. A few of them have actually sped up their return now. They're coming back. Right.
Yeah. I've got quite a few actually. I've sort of had a few split families where they're, one of the two spouses would stay in the UAE and the other would take the kids back into Australia. So I've had a few urgent residency discussions with clients saying, hey, what's my situation here? And the good thing is we've got kind of all the COVID horrible experiences that everyone had, but set precedent. So normally in those kind of, temporary situations, you can easily kind of remain offshore. You can sort of easily move to Australia on a temporary basis for an extended period of time and still maintaining on residency position.
Yeah. And so now that you're back in Australia, has business changed a great deal for you then, or are you still working cross-border in the way that you were in Singapore and Australia at the same sake?
Yeah, look, it's, I guess physically being present in Melbourne now, there's a little bit more resident work coming my way. I'm starting to pick up a few businesses, which is nice to get back into, fully fledged Aussie businesses. But still got plenty of expats. Like there's still quite a bit of movement on the expat front, which is nice. I've had a lot of discussions with people moving to Hong Kong, moving to Singapore, which, every now and again, I guess if you hang around the wrong circles of people, you start doubting that, expats are moving offshore, and then you get this big wave of expat professionals moving offshore, and you say, yep, it's still alive and well. People are still looking to expand their horizons offshore, explore career opportunities. And, to be honest, for anyone that hasn't done it, I would highly recommend if it's an option for you to consider a stint offshore. Yeah.
And in terms of the countries going offshore, so what are the dominant countries you're typically seeing Aussies go to? Singapore being one.
Yeah.
Well, what are some of the others you're typically working with?
Hong Kong. Yeah, Hong Kong. So, and this is like, I've never actually lived in Hong Kong before, but, having regular conversations with clients moving to Hong Kong, clients based there. Hong Kong obviously went through a rough period with the protests and the and and the like. But I'm told from people on the ground that it's very much alive and well, and it's basically businesses are going well and people are moving to Hong Kong. So yeah, that's more kind of probably more of a product of the markets that I work in. I'm very much Southeast Asia, so they're the ones I'm seeing a lot of people moving over to. But easily Singapore, Hong Kong most popular, and then there's a scatter of people kind of moving around the rest of Southeast Asia.
Any major appeal towards some of the other countries? Like I've seen some clients with Indonesia and Thailand. Is there any things that are really driving people there, or is it more of a cost of living thing relative to say Singapore?
Well, definitely cost of living. So I think that you sort of hit the nail on the head. So I've got a good friend of mine was staying in Singapore for a long period of time. Him and his family decided to rebase himself in Bali. And the way he's got himself set up is fantastic. He's like 10 minutes drive from the airport. He was saying to me that he runs a business in Singapore, and he will every second week he'll go to Singapore for 2 or 3 nights. And he said it's wake up at 6 a.m, get changed, pack the bag. You're in the airport at 7 a.m. with a coffee in your hands, and you're in Singapore by 9 a.m. kind of thing. So it's I think it's travel time, but it's it sounded like very much just an extended commute to work. Stay there for a few days, and then it's a pretty seamless trip back sort of thing. So and that sounds like a great lifestyle. He was sort of sharing the cost of living savings. Rent was like a third of the cost, and get lots of help in Bali. Bali obviously infrastructure wise is very different to Singapore, but there's still good schools there, good medical, good lifestyle. Some pretty good damn cafes there too as well.
Yeah, coffee's not too bad.
Coffee's not too bad as well. Not too bad at all.
I know when we caught up in that coffee shop in Singapore, that wasn't too bad.
That was pretty good actually. That was the Singapore coffee market. That's a whole nother podcast actually. I've got a lucky to know one of my clients was one of the trailblazers for good coffee in Singapore.
Really?
And he's since sold his brand.
Was that an Aussie?
Aussie, yeah. Aussie based out of Perth, surprise.
Interesting.
Brought this really cool coffee culture to Singapore, opened up a couple of cafes. The cafes are now everywhere. He sold it on to private equity. Cafes are everywhere. I even saw his coffee brand. I was on a Scoot flight and I ordered a coffee and with low expectations, and it was a coffee bag from his brand, which is it's sold on to private equity. I was like, wow, there we go.
So in that scenario, we don't have to know names or anything, but was that a business based over in Singapore, or it was
That was
Yeah. So he sold and paid no tax on the sale?
Correct. Exactly. Yeah. Exactly. Sort of 5 minutes before COVID as well. So that was a very lucky event. But part of the appeal of Singapore is the capital gains tax-free nature of selling businesses over there.
Well, let's dive into it, because the Australian government hasn't been doing itself any favors lately. Lots happening even in the last couple of days. Still more things coming out that are going to be impacting Australians and investors. But if we stay on the theme of the expat space, is there anything new that's happened in the last 12 months that's been relevant for expats specifically, or is it just more related to everything that's been announced in the budget, which is obviously going to have an impact on expats as well? Or has there been any movement around anything just unique to expats in the last 12 months?
Look at the in the market. When I was living and working in Singapore, the biggest challenges for expats was finding an employment pass. That was or a visa. In Singapore, they call them employment passes. I think there's a similar arrangement in Hong Kong, is effectively just getting work rights. And Singapore was changing the quotas for minimum salary and qualifications, and effectively you go over there and say, I'm an accountant, I'd like a job. And if you're, for example, a middle manager, accountant or banker going to Singapore, try and find a job, very hard to get anyone to sponsor you, because there's a lot of supply from a Singaporean standpoint of a lot of good accountants and good bankers and lawyers and that sort of thing. So the hardest thing was getting an employment pass. Since then, Singapore has introduced something called a One Pass, which is effectively an executive style employment pass. Minimum salary has to be $30,000 a month, excluding bonuses. So it's a fairly high bar. But that does give your spouse working rights, which was quite a big thing. So I had a lot of situations where people would go over to Singapore, they get an employment pass, and the spouse, for whatever reason, couldn't, because maybe their profession wasn't recognised. You remember before the podcast, I'm talking about plumbers, right? I had and plumbers in Australia, a lot of them will get paid as good as white collar professionals, because it's a good business. And but in Singapore, it's just not recognised. So if you go over there as a plumber, try and get a job, you're not going to be able to get one.
Yeah.
Or if you get a job, you're working for a very low hourly wage. But but now with this kind of one pass, effectively your spouse has got working rights. So that's a major thing that's changed from an actual Singapore standpoint.
Yeah.
But look, I think it feels to me that some businesses are doing well, and they're investing and sending their staff offshore at the moment, which is good to see.
Anything majorly different than, like you said, Hong Kong earlier, in terms of setting up in Hong Kong and going over there and getting working rights and things? Is it materially different to what you're seeing in Singapore? Or
from what I'm aware of, it's similar to Singapore. Is you need to find an employer first before you move over there, kind of thing. So, which is a little bit the chicken before the egg scenario. So you need to some people say you need to be on the ground to find a job. It's easier that way, but how are you going to basically get over there and get on the ground? So it's a lot of the time getting that first internal transfer within a large company will sort of get your foot in the door. And once you're there working in markets, then it's a lot easier to find a transfer job, somewhere else, like work from somewhere else. And I think you're naturally a much more attractive candidate for those two markets that if you're already there working away.
Interesting. And I guess, the expat dream and moving offshore, it surely has gotten a whole lot more appealing to Australians now, post what the budget announcements have been. The changes to CGT, the minimum CGT tax rate of 30%, negative gearing basically being abolished in a way for investment properties. We already had Division 296 tax in place, but that's just another change to name. And then just in the last couple of days, we've seen the government come out around the self-managed super funds and basically are hitting any self-managed super fund moving forwards from the ability to borrow to buy a residential property, and therefore you basically won't be able to do it. And there's still, I think, a little bit of dust to settle around some of the particulars there, but the government's going hard on hitting investors, and we're chatting a little bit before we started the podcast on the whole idea of it. But I've had conversations with clients, and the one thing I'm really most worried about is it really is pissing off business owners. Like, I know a lot of business owners are really frustrated around this. When you start a business, you're buying into a business and you're scaling it up. Like, you're taking on all of the risk for the hope of maybe a reward at the end, and you're one of the lucky few that succeed, and then maybe you sell and you actually make some dollars out of it. But now with the minimum CGT tax changes, and that just starts at 30%, it can still go upwards to the 47. What have you been telling clients, and what sort of conversations have you been having? And have you had any clients then reaching out going, "Hey, Tristan, should we be considering maybe moving offshore and exploring that?"
Yeah. So the short answer is yes. It's a regular conversation where people say, "Hey, you're an expat specialist. Should I consider rebasing my business offshore?" So there's a range of things to consider, but the hardest one is disconnecting your business from Australia, and is it suitable to disconnect from Australia as well, right? Yep. So with that comes should you physically move offshore as well and change your residency? That's always definitely the easiest as well. Having a business that's based offshore, but you're physically based in Australia as a resident for tax purposes can be tricky, because at some point you're going to, if you're able to rebase, for example, the IP, offshore. So you've got a business that's got IP that might be a trademark. It might be, sort of name, brand, image, so firstly, disconnecting that from Australia and moving it offshore, you got to have a ding sale event. So that's the hardest thing. So, as a resident for tax purposes, you tax on worldwide income, worldwide assets. In order to disconnect that asset and move it to an offshore base, taxman puts out his hand and says, "Pay me the market value of that asset." When you're moving, and I've had situations, I've had the good and the bad with that situation. So I've had, for example, very successful media company that originally is a small company, very ambitious. He moved offshore. He was able to do the deem sale because he had some cash in the bank. It's always hard to pay capital gains tax on an asset when you've got no cash coming out of the sale. Like it's just basically a paper sale. He was able to base himself in Singapore, built up the business for many years, and then sold it, be capital gains tax free upside from that. So great success story. And he's out there. He's going back for round 2. So, it's one of these, they build up a business, does well, sell it, and then they get bored. They do a trip around the world, play a heap of golf, and then decide, I want to do it again. Go back and do it again. But I've had other situations where fairly mature businesses have said, hey, we need to move offshore into the Singapore market because that'll open up shipping channels and there will be easy to travel around the world, deal with different time zones. They've moved to Singapore, they've done the calculations for the deemed sale and just went, oh, that's too much money that we have to find for a business that's going through that stage where it's maybe it's asset rich, cash poor, that maybe it's got great turnover, but we just don't have great margin at the moment because, the value of the business is tied up in the actual business itself. Where they've had to say, we're in Singapore, but we're just going to have to pay capital gains tax on this thing because, we can't afford to not do it until we sell the business because we need to either that or you bring in private equity partners that can effectively pay you money for part of the business and then you use that to pay the tax man. So that's kind of one of the biggest challenges is disconnecting the asset from Australia to start off with. You need a good rock solid market valuation for that as well. In case the tax man comes knocking to have a look, external valuer that can give you that business valuation because at the end of the day, if the tax office scrutinises your business, that's what they're going to do themselves. They're going to get their own external business valuation expert to look at the value of the business.
So it really feels like if you're going to be doing that, you really have to be doing it before the hockey stick sort of growth happens in a business. You don't want to have already gone like this and then shot up, and then you look to go offshore, and then like you said there, you might not want to actually sell any part of your business at that point in time. But so because I want to dive in, we touched on it in the first podcast around the deemed acquisition, deemed disposal rule. So in that situation, if we stay on the theme for business owners, so I'm a business owner, I want to go offshore. Is there there's a period of time, isn't there, by which you have to make the decision if you're going to do a deemed disposal? And then if you don't do a deemed disposal, what's the differences there, or how does that work? So do you have to make the choice on doing it or not, or you could theoretically, I suppose, go live in Singapore and not do a deemed disposal at all?
Correct. Yeah. So if we, let's use now. So it's June. You say, hey, I'm going to move my business offshore. I'm going to move myself as well. So that makes it quite an easy scenario. Jump on a plane, uproot the family, off you go, set yourself up in another country. And it might be Singapore, it could be another country that's friendly for, capital gains tax free, on global assets. This falls within the 2026 financial year. So effectively by the time you lodge your 2026 tax return, then you've got until that lodgement date on whether you want to include in the tax return or not, and that's your kind of one and only choice. Tax office don't like you to amend tax returns to include it, because they see you sort of taking advantage of a situation. If we said let's do it in a month's time in July, we say okay, that's FY27. Then you could have as late as, if you moved in July, then you could have as late as call it May or June 2028. To make that decision that, the lodgement date of the 2027 tax return. So you've got a little bit of a buffer to kind of, to work it out, to try and find some capital, beg, borrow, steal, all that sort of thing. And back yourself basically. Because that's effectively what you got to do in order for that sort of situation. So, and for those that are not moving businesses offshore, the same rules apply to shares. So, moving offshore as an expatriate, having that deemed disposal, all or nothing. So you can't pick and choose. And then that goes in your tax return, disconnects all your assets for capital gains tax purposes, and it's happy days from that point onwards until such time you return to Australia. And
then if you don't opt for the deemed disposal, essentially it would just be treated for tax. Like the gain whilst you're offshore is just fully counted. There's no taxable event at that point in time, but then when you eventually, I suppose, want to either sell and or relocate back to Australia, there's no cost-based reset or anything of the sort. So it's just the growth will just be fully taxed. Like you just stayed in Australia, would that make sense?
Look at you probably would get, excuse the term, stitched up a bit because you would hang on to the asset, you'd move offshore, you'd be a non-resident for a period of time. So obviously these the 50% capital gains tax discount would not be applicable for those years. But obviously overlaying, we've got these new changes from 1 July 2027 coming in. So question on indexation on whether that applies to non-residents. We think it does, but obviously we're waiting for that legislation to hit. The actual a bit more reading material, so we can get into the weeds and understand it. But in that situation, the asset remains taxable Australian real property. When you're a resident for Australia, a resident of Australia for tax purposes, all your stuff is considered taxable Australian real property. If you can't disconnect it, it continues to be taxable Australian real property. And then, effectively, when you come back and sell it, or you sell it when you're offshore, you've got a gain that you've got to bring to account.
Yeah, and as a non-resident, we're not getting the CGT discount, and you're just straight into non-resident tax rates, and there's the tax-free throreshold. Or is it from $1? It's 30% or 32%?
Correct. 30% from $1. Yeah, all the way up to 135. Ish. Someone on reading the podcast is probably going to correct me on that, but it's around about that number. And no Medicare levy, of course, but you're paying tax on it. You can still make a deductible super contribution to help offset that, take the edge off it.
Yes. Yeah. And I can guarantee there has been people that have gone offshore and haven't even thought about this stuff, and they're in a position where they've got no choice, really.
Exactly. Like it's one of those sad ones that if you don't know about it at the time, if your tax advisor misses advising you on it, then the horse is bolted. It's one of these things that once you lodge your tax return, that door shuts basically, or that's the view the tax office have. You could probably go back and argue it that you meant to put it in there. It was a genuine mistake, but I'd rather not have that argument with the tax office because I don't know how well you do.
So Tristan, just so I've got it right for people listening around the deemed disposal and how that would be working. So let's just paint a scenario. Say for simplicity, someone's business is, well, say they started it from scratch. They go, or they're going to move offshore, and let's just say it's worth $1 million at that point in time. Like they've had a genuine valuation, the business is worth $1 million. I guess we won't get into the weeds of maybe what they've contributed towards the business and what the original cost base is. Let's just assume it was zero. So they've just literally grown it from zero. It's worth $1 million. So at that point in time, if they're to then go and move offshore, because we said they've got a business, it hasn't really hit the hockey stick moment yet, but they've got all this growth potential. They're thinking about they're going to launch whatever it may be in their business. So they want to get offshore and do it in a more tax-friendly environment. So in that scenario, they would be making a choice to do a deemed disposal. There's $1 million taxable event, although they haven't actually sold their business, but they're going to be taxed on the $1 million.
Correct.
They will get their 50% CGT discount whilst they do that. So in that scenario, they're just virtually going to be taxed on $500,000 at the normal Australian tax rates. Is that simply how it
look, you probably get some CGT small business concessions there too.
So you can still utilize those even when going off, so you can take advantage of some of those.
You can. So it's effectively still treated as a business sale. So effectively you're deeming it sold, and you might be, the buyer could be a foreign entity that you're selling it to, so to speak. So you might be selling from ABC Co in Australia to XYZ Co in Singapore, kind of thing. So CGT small business concessions. You might even be able to make a super contribution, but I realize cash is probably going to be king in this situation because all that cash you're probably going to need to set up in a foreign jurisdiction as well. So it's a matter of kind of working through those concessions, working out what that number is, and then working out the timing. Like we're talking about now, right? If you did it in June, it would get caught by the that particular financial year. But if you do it in July or the first quarter of the new financial year, it just gives you a little bit more time to save up for that tax, or to to manage your business cash flows for when that tax bill comes around.
And then that's why I think it's tricky for people to understand that, particularly when I talk to clients around it. Is you're selling the asset on paper, but you haven't actually sold it, and then you're paying tax at that point in time.
Yep.
But you still do own the asset, so you need to have the cash there because you're not liquidating anything at all. So unless in our scenario, you've got cash to pay the tax bill, then you're going to be in a little bit of strife, like you said. So you really want to look at the timing or where the money might actually be coming from at the same time. And that's obviously applying for shares, managed funds, and really that only won't apply. It's just basically property and managed funds being, say, REITs, like real estate investment trust. They get grouped under that as well. So you can do a deemed disposal on anything property wise.
Correct. Yeah. Anything property wise now. With certain property style investments, in order for it to be deemed a TARP asset, taxable Australian real property asset, there's certain characteristics. So it's generally only a small property investment where there's only so many property investors that are involved in it that you won't be able to deem sale. But the larger, for example, Macquarie Airports or something like that, where it's basically just the car park, collecting money and they're fine to deem sale, even though that's largely, if you think about it, it's just it's a property asset because it's big enough you can deem sale that. So, but something like I guess a word of warning for the deem sale is it is a choice that you make that may not go your way as well. So in the sense that you might get the $1 million valuation, you get your external valuers report basically says, yep, the business is worth $1 million here. But say you go offshore and for whatever reason the business doesn't work out, as in you've given it your best, and effectively you end up with basically a room with a few tables and chairs and that's it, kind of thing. There's no capital loss that can be recognised in that situation because you've deemed sold it. So that's the downside. So it's one of those things that you, and that also applies to shares and the like too, right? So if you've got a share portfolio where you're looking at it and you're going, well, I could deem sell it here, but I think the share portfolio is going to go down, or it might be, it might be headed in the wrong direction, and you might just end up selling all the shares. You might as well not do the deem sell, sell them here, crystallize the capital loss, and then that'll roll forward forever until it's used again. So, if you're offshore, those capital losses just roll forward forever. So, at some point you can use them again in the future. Yeah.
And then the common one I'm always seeing now is in investment properties, what's happening, which is you can't do any deemed sale on those, unfortunately. And the interesting one where we've had a mutual client lately with, family home and how the family home works when you go offshore. So could we touch lightly a bit on how the family home works? Because what most expats are generally doing, assuming the whole family goes offshore, and then I suppose it does get trickier if, say, hubby goes offshore, mum's staying home, and there's kids here, and then has work at residency and so on. But if we use a simple scenario of everyone goes offshore, the family home usually gets rented out at that point in time. But then in that scenario, this is where I've had some clients get a little bit tripped up around it. It's like, what's happening there at that point? Like, there's no CGT discount. Well, let's say under the current rules anyway, because the rules are about to change. But the family home can be sold tax-free in Australia. But if you then move offshore and say you've owned it for 10 years, you can sell it tax-free if it's your family home right now. But then you go offshore for, say, 10 years, that 10-year period of time, what is it looking like in that stage? And does the 6-year rule, is that even still relevant for someone if they owned it for, say, 10 years and then went offshore for, say, 3 and come home? Can they play around with the 6-year rule there at all?
Really good question. So really important that the principal place of residence rules haven't changed since our last major change a few years ago. So that last major change was the principal place of residence exemption is still around, but you have to be a resident for tax purposes when that sale event happens. So so in a really simplistic situation, you bought a house, you moved into it, you've established as your family home. You've then got an overseas posting for 3 years. Really simple. Go ashore 3 years, have a good time, rent out the house during that time, then come back and return to the property and continue living there. So in that situation, the rental income you earn has to be disclosed. That's, maybe make a negative gearing loss on that. And, if it's a property that you held on budget nights, May 2026, then that those negative gearing benefits are still available to you because that's a property you owned at that point. Because you're leaving the property, returning to it, re-establishing as your home, no change to the capital gains tax profile, still capital gains tax free. So that's still around.
Good news.
However, if you get over there in year 2 and then decide the property market's going gangbusters and you want to sell your home and get some cash out, miss out on the entire principal place of residence exemption on the whole property. So
even the time when you were...
Even the time before. So disaster. So that's one. So that's, and sadly when those rules happened, not everyone knew about them, right? Like there's a lot of conveyancers that have found out about them through education, sadly some through the wrong way, but a lot of accountants that are aware of it now too. So it's rare that someone would have a situation where suddenly they're like, oh, I'm back to lose this principal place of residence exemption. Had a phone call yesterday actually. Client said to me, hey, I've got an apartment in this lovely block of flats in Sydney, collective sales come around. The officer going through and I said, have you lived in the property before? And they said, yes, it was our home for 10 years before we moved offshore. And I was like, oh no. So in that sort of situation, a lot of the value had accrued in that apartment block whilst that client was living there. So they lived there for similar situation, 10 years.
Yep.
Have lived offshore for many years, I think 5 or 6. If that collective sale goes through and they're a non-resident of Australia for tax purposes, whole thing gone. Yeah, miss out on the principal place of residence exemption. They'll get an apportioned 50% discount for the time that they're a resident, but so then the conversation progressed with the client saying, shall we move back?
Yeah.
So that sort of thing. So the principal place of residence exemption is still a powerful tool. If you have a situation where you're a longer term expat, you move offshore, you're offshore for more than 6 years, because the 6-year absence rule, you can then continue to treat it as your family home for that 6-year period. Time beyond that starts accruing a tax liability. But providing you're a resident for tax purposes in the future, when you sell the property, you don't necessarily have to move back into it. Then you'll get the time you live there, you'll get the 6-year exemption, and you'll obviously get a discount that's kind of overlaid on top of that as well. So that concession is still alive and well. Just don't sell it when you're offshore.
That's really good information, because even in my mind, I found that a little bit confusing with properties, and I've got a few clients that have come up late. And I guess the other one that has come up lately, because it's a mutual client that we're working with, is the family home is an interesting one, because I suppose the common scenario I've generally seen is one goes offshore and gets the job offering. And then in some situations, the family's staying back here because schooling, all life's there, and everything's established in Australia. So in that scenario, which was again learnings for me recently, of okay, the family home is saying the husband's name, but then gone offshore, and then the family's still then back here living in that property, but then land tax is starting to focus. Tell even else not as an investment property. So that to me was that was surprising, because then I had my first thought of, all right, should we be paying any land tax? You can, or depending on states, you can transfer the title to a spouse, and there's not a taxable event. The home you live in, that is not an investment property, or stamp duty. And I did that before I got involved in business. So that was my first thought. But then you've looked at that and basically can't do it. And so you'd want to be really careful, I think, about that as well, when you're going on tour and looking at whose name the property is in, because it could be in one person's name, that person goes offshore. Correct. I think you're paying land tax, but amazing job.
It's a exactly. Don't get me started on land tax, but I guess the main thing is every state is different, and they're all complicated on the land tax fronts. The land tax strategy is as important as the income tax strategy as well, because some of those land tax rates can be nasty. So in this situation, the property was 100% in the spouse's name who was living offshore. The other spouse was living in the house as their main residence. Victoria is quite strict on ownership and land tax. So I think New South Wales are a bit flexible. I think you can be at least a 25% owner and you can qualify for the full principal place of residence exemption on your land tax. But Victoria are quite strict. It's like ownership, and with this client, we said, hey, can we transfer the title across? And because he is a non-resident, the 50% the principal place of residence exemption would not apply. So I have to pay tax on, capital gains tax on the whole transfer. and the stamp duty exemption may not apply as well. I'm not thinking through it. Please don't crucify me, anyone listening to the podcast on this, but the spousal transfer exemption, I think both spouses need to be a resident. I think that's the case. But the main thing is each state is difficult and complicated. And it's important just to note when that land tax date is, right? So, for Victoria and New South Wales, it's 31 December. Conveniently, myself and my wife, when we moved back, we were able to get back and get into our house in Hampton before that 31 December date, contact the SRO, say, hey, we're back, here's an electricity bill in our name, et cetera. Here's a bank statement. So they were satisfied, and, that's now converted to a PPR exemption. But if you come back on the 1st of January, you get a land tax bill for the whole year. There's no apportionment. So it's kind of brutal.
That's incredible. But it just talks to how complex this is, and really why the importance of like working with someone like yourself around this stuff. Because I work around it as an advisor, but there's still even things like I'm just learning talking to you about it now, that all these little nuances and little tricks, like the principal home one, I wasn't aware of that until I'd seen it with the client. I was like, God, I was surprised to learn that they're paying land tax on it. So it clearly pays to get good advice. Moving to, I suppose, what Singapore tax rates, have they changed in the last 12 months? And can you remind us what sort of tax rates we're looking at?
Yeah, so Singapore tax rates, top marginal tax rate is 24% over $1 million. Wow. But it's a 22% and below under $1 million. So, for example, if you're on the brackets, basically that kicks in from 22% to 24% is about 320,000. So, and on that, if you were on 320,000, your average tax rate something like 13 or 14%. So it's it's a pretty friendly tax environment.
Yeah.
No capital gains tax, of course. That's we've been talking about that. That's a big win. No income tax on personal investments. So if you have basically interest in bank accounts, dividends, with global dividends, you've just got to deal with whatever the withholding tax ramifications are. So if you've got ASX stocks, they're paying you fully franked dividends, keep the cash, lose a franking credit, nothing else to do, don't do any tax return.
Yep.
Friendly tax jurisdiction, and the actual, income tax there, most people just do it themselves because it, takes 5 minutes. If I was an income tax, personal tax accountant in Singapore, I probably wouldn't have a job. I would be very busy.
I tell you that. Fair. No, that's fair. And the government over there, pro business, and is that the attitude?
Yeah, very pro business. Like it's sort of the obviously the foreign talent piece. So as an Aussie expat coming over there, getting that employment pass is the biggest hurdle. Once you get that, you're home and host. If you're looking at going over there to actually set up your own business, there's definitely paths you can do that. So, setting up your own company and getting yourself a what's called a letter of consent. You can at least get that for 12 months to get yourself started. Then after that, you need to employ a local in the company in order to get that renewed.
Yep.
So there's definitely ways that you can move over there and start a business. But cost of living is the big consideration for moving to Singapore. So, if you're a smaller business, once you see the rents and cost of living, you might be like, holy moly. So, there's a big troop of people that are living either in Bali, living in Phuket, Thailand, or even Vietnam. Vietnam's become quite popular as well. So you might base yourself and your family in one of those kind of surrounding countries that have got pretty good international schools, pretty good healthcare, easy to get in relatively easy to get in and out of them. And then you might have a Singapore holding company, and a registered office there that you're actually trading the company through.
Interesting. So still tax resident of Singapore, but living in one of these two countries.
Correct.
Yeah. Okay. That sounds like a good strategy. So going back to talking about for business owners, because if there are people listening, I'm sure there then will be, and I have clients in this exact category where maybe they're starting their business or they're at the beginning of it. In terms of relocating offshore, we were talking about like plumbers before. In terms of like the realities of, okay, anyone listening, could you theoretically move your business offshore? It's like, okay, if you're a plumber in all your contracts here in Australia and you're on the tours, like the reality is you can't really shift that offshore.
Yep.
I'm sure there's demand for plumbers in Singapore, so maybe you could set up there again. But I guess I'm more so looking at people or brands or businesses that have like an online and they don't really have a physical shop front. So I guess there's nothing keeping them in Australia in a way, like in terms of their, I'm sure, family ties and things, but for their actual business. Like some of them may not even have many staff, or they just work fully remote. And I have clients that do exactly this. That's really got to be the appeal for shifting over to a place like Singapore, and say the business value is minimal to none because they're just starting it. I'll be really thinking, if I'm in my 20s or even early 30s and I've got nothing to lose, maybe I haven't started a family or anything of sorts, like I don't know what would be keeping some people in Australia these days. With all of what's going on, it's just the appeal and the just all of what the government's now doing. What would be stopping people from going?
Yeah, look, exactly that situation. If you're single or a couple, and your lives are relatively flexible, definitely get out there and have a look. Have a look at the options. So in the sense that the easiest way is to change your residency. So to actually move offshore, and the residency rules haven't changed for since the 1936 Tax Act. So we're still dealing with the same residency rules. Slight disclaimer: we do have some proposed changes that have been stuck in Parliament for a few years, but nothing's popped out of that yet. But basically, you need to have a longer term intention. So you need to move offshore with at least a 2-year intention. If your time offshore is less than that, that's okay. Like in the sense that things don't work out, you come out after 1 year, as long as you show that you basically intended to move offshore for 2 years. So you had a 2-year lease, or you effectively rented out your house, packed up your affairs. If you're only renting, you just basically you've effectively packed up your stuff and left it in your parents' garage or in a storage container or that sort of thing, and up this your life with an intention to move offshore. Get the appropriate visa. So I know there's definitely channels in, for example, getting flexible visas in Indonesia if you wanted to set up there. And each country is a little bit different, but there's definitely ways to kind of explore that. And maybe that's a topic for discussion for another podcast. Is the getting the right contacts in each country, so you can kind of learn how to set yourself up properly and what you can and can't do in that country. Where to set up your bank accounts and all that sort of thing. It's probably Singapore. But they're apart from, the next thing would just be the cost of doing it, right? So working out where you're going to base yourself. Cost of living in Singapore is always and Hong Kong is also a topic that's discussed a lot. Having school age kids, basically in Singapore you don't really have access to the public school system. You can if you really try, but it's hard to get into and not necessarily convenient. So it's generally going to an international school. International school fees are same or higher than private school fees in Melbourne. I was actually quite surprised when I brought my kids back, and they were in sort of an okay international school, not the top international school, and not the cheapest by far. Private school fees in Melbourne were cheaper, so I was quite happy with that. We're like, oh, I got a discount. That's great. Yeah. So so that plus rent as well. So signing up for apartments and just the general cost of living. I think you'd find that Singapore is similar to living in Melbourne. There's some wins in some areas, like you go out for fairly cheap hawker centre food in Singapore. For $5 or less, you can get a pretty tasty meal. Health, is it healthy? Question mark on that, but delicious. Groceries, you probably pay a bit more in Singapore than you will in Australia if you want to eat kind of typical foods that we're used to eating in Australia. But that's the major things is availability to move your business over there. So where are you going to base yourself? What sort of visa are you going to get to stay? Rents, schooling if you've got kids, but no kids, that's easy. And just working out your budget for cost of living.
Yeah, no, that's great. All right, Tristan, so getting to closing, I wanted to touch one more time on the deemed acquisition disposal rules, because I've had clients and worked together with you on some clients where they've gone offshore, they get sucked into these investment products. Yeah. There's all these investment advisors, and the rules over in some of these other countries like UAE and Singapore, very, very different to how they are in Australia. And Australia's been through a lot of regulation, but every single time I see those scenarios, they've gone offshore some type of advisor has reached out to them. They've sucked them into these, what they think are tax haven-like products, where there is incredibly high fees. There's all these commissions that are generally not disclosed, they're not even aware of. And that has a massive impact on their return. Every single time I've seen them, and that's the way that they've looked. But the reason why I want to talk about it is because a lot of people don't realize once they've gone offshore and they're a genuine non-tax resident, they could be investing back in, their share portfolios or their managed funds or ETFs. And the cost base will actually reset once they come back to Australia. So simple as that scenario, I go offshore, I've got $250,000. Let's just say I invest that into BHB. We don't stock pick in our business, but let's just assume we do for simplicity. So I buy $250,000 of BHB whilst I'm over in Singapore. I come back 10 years later and let's just say it's worth $1 million. So it's grown from 250K up to $1 million. And then I recommence my tax residency. That $750,000 gain essentially is ignored. And then I could be an Australian tax resident. And then the next day, if I'm then to sell, assuming all things equal, the share price didn't change overnight or over that one day, I could basically pay no capital gains tax in that scenario. So that blew my mind when I first learned about it. And I think that's what I always speak to a lot of non-resident clients around, is like, you can be investing back in Australia basically tax-free, although you're going to still get taxed on the income, and then you can still make super contributions. Every client I have that's offshore generally has negatively geared properties back here as well, which is then offsetting any income. But that's a game changer. And when I learned that, I was like, that's absolutely amazing. There's so many expats miss it.
Yeah, there's a big thing. So, when you move offshore, your fully franked dividends convert to being taxed under the withholding tax system. So, keep the cash, lose the franking credit. Don't even have to put in tax returns. So it's quite straightforward. And you can, exactly as you said, you can literally hold the same parcel of shares, provided you do the deemed sale and deemed acquisition. So, in that BHP situation, the only thing you're going to miss out on is the 50% capital gains tax discount, which is a funny test, and this will be academic sooner or later anyway when the discount gets wound out. But, that test gets tested on the whole holding time of the asset, so even the non-resident time. So if you sell those shares, 3 months after you get back to Australia and, they've gone up from $1 million to, $1,050,000 or something like that. So you got a $50,000 capital gain to deal with. That $50,000 will get a partial discount because it looks at the whole time you've held the shares. But absolutely, you can sort of keep the same share portfolio. I always encourage clients to consider restructuring when they're moving back to Australia as well. It's a good time to, you're coming in, you've got a clean slate for capital gains tax purposes. In the good old days, I used to say, "Hey, set up a discretionary trust." But yeah, now it's looking at do you want to contribute them to super or potentially put them in a Australian company. We need to work through these things with the current legislation.
No, that was a game changer when I learned that. So I think that's a really good one to get close to finishing on. And just in closing, then getting to any sort of horror stories. Like, we're talking about all the great things of living and working offshore, tax-free over in Singapore, no CGT, amazing for a business owner, but it can't always be, have you seen some things go wrong?
Look, yes, absolutely. Like even thinking in my journey, there was a point in time that I found it hard to get a job when I first got over there. So there's expat families that go over. I was a trailing spouse, so I went over. My wife straight away was working from day one in a sort of a big corporate legal job, and I've seen a lot with for example, trailing spouses. You go over, one of the two is having a great time and they're busy with meetings and flying everywhere and saying, hey, this is the life. And the other one's stuck back in the apartment and they're, they haven't found their people. They haven't found, they haven't connected, that maybe they haven't found a job and they're just kicking around the apartment, and saying, no one understands me here. I'm speaking English to everyone and they're speaking English back, but I can't get a connection. And in those sort of situations, if you are going offshore, you've just got to get out there and connect with all the social groups. There's a lot of social groups for that reason. But and there's plenty of clients that they come offshore, they do it for a couple of years and they say it's not for us. Go back. So I guess it's important just having realistic expectations. Like it's get out there, obviously maximize your time when you're traveling, but and make sure you look after your spouse as well. Make sure that they're connecting with the right people, and if they're not, there's plenty of sort of Aussie expats groups like in Singapore. There's Australian and New Zealand Association, also and lots of other groups you can get involved with, so you can kind of connect with people and talk to them about the challenges you're having.
I think that's really good advice. And then getting to closing it, mate, because you're, I think, the second guest officially in the office in the podcast.
Yes.
So that's awesome. But I actually asked the last guest a question, which I haven't given you any pre-warning about. So I hope you're going to be okay. But it's nothing, nothing too stressful here. But I'm always curious of just everyone's journeys and learnings different through life. And the one that I wanted to ask you is, what, like, if you can reflect on your journey thus far, and this could be finance, accounting, or anything related to their life in general, what's some of the best advice that sticks out in your mind that you've ever received? And it could be from anyone, life, financial, accounting, just something you've taken with you.
I think it's just be honest, and I know this comes without saying it. And when you make a mistake, own up to it quickly.
Yep.
I've heard some people say fail and fail fast.
Yep.
So own up to it quickly. And say, I made a mistake. Let's right this wrong. Let's get back on top of it. And you learn a lot. Pride can get in the way sometimes, but that's probably one of the biggest pieces of biggest lessons I've learned in professional services is, you can make a mistake. It sucks when you do, and you do as many things as you can to make sure that doesn't happen, and you proceed carefully. But when you do make a mistake, own it quickly.
Yeah,
own it quickly, and then fix it up basically. Yeah. And a lot of the time when you do that with a client, they'll respect you, and you'll have that client for life. Providing they can see that you're doing trying your hardest to to right the wrong.
Yeah, mate, I love it. That was awesome. Didn't give you any warning either.
Yeah,
So that was good.
Nice.
But we'll close out, mate. So where can everyone find you, Tristan? So name of the business, and where is it best? If someone was listening and wanted to reach out, what's the best way to do it?
Yeah, so best way, I'm based in Brighton, so we're just down the bottom end of Church Street there. Yep. But always happy to have a catch-up meeting. So for expats, bounced around, I've got a calendar link. You can always just jump in there and book in a 20-minute catch-up. Have a quick chat about your situation and see if I can offer you any advice or anything like that. So the calendar link's probably the easiest.
Yeah, amazing. And what we'll do is we'll drop it in the show notes as well. So anyone listening that wants to come straight in, you can literally just jump in there and book in a time, chat with Tristan. But Tristan, I think you're the first actual return guest as well. So you've broken a few records today.
I like it.
We'll have to get you on again because there's so much more that we could just keep on delving and diving into. And we'll see how all of these changes roll out with the budget and hopefully the government doesn't throw anything more at us. But mate, really appreciate you being on here, and hopefully we'll see you again soon.
Thanks, Josh. Really appreciate it.
Thanks for listening to the Winner's Playbook. If you've enjoyed this episode, make sure you follow or subscribe so you don't miss the next one. If you got value out of it, we'd really appreciate a 5-star review. Just remember, the information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on anything discussed, consider whether it's appropriate for your circumstances. If you need advice tailored to your specific situation, reach out to the team at Link Wealth. Thanks again, and we'll see you next time.